All right, welcome back, everybody. This is module 3 of the wholesaling class. In this module, we're going to talk about preparing for the deal and all of the things and tools and math equations and everything that you need in order to prepare to put a wholesale deal together. So let's go ahead and dive in. Now, just like with every class, I've got to give you, or with every module, I've got to give you a quick disclosure. I'm not a licensed attorney, accountant, financial advisor, real estate broker, real estate agent, or any other licensed individual. I'm a student just like you. I've got some really good information that's made me a really decent amount of money. So I want to share these things with you so that you can go out and start building your real estate portfolio. So let's dive in. Now, the first step to preparing for a wholesale deal is to set goals. We have to have something that's going to drive us to build our wholesaling business, and goals are a great way to do that. Now, just like with anything in real estate investing, it's not necessarily easy. It does require hard work. It's simple. A lot of these strategies are very simple. And as you see, as you'll go through these courses, it's a very simple system that we use, but it does require a lot of time, a lot of knowledge, and a lot of effort to go out and be successful with this stuff. So one of the first things that you want to be cognizant of as you're setting these goals is that you need to use math and statistics to set your goals. So what I mean by that is it's going to take a trial and error period as you get started, especially if going out and finding deals is something that you've never done before. You have to be patient with yourself. As human beings, I've said this a number of times in many different classes, as human beings, we suck at things that we've never done before. That's just part of the human experience. And so you've got to be patient with yourself to get through the learning curve. You've got to be willing to go out and pound the pavement for a while and fall flat on your face, pick yourself up and do it again and keep doing it until you develop the skills that are going to make you successful with this. So be prepared for that learning curve. But as you're out, keep track of the people you talk to. Keep track of how many people you talk to. Keep track of how many of those say no. And if you've watched our off-market deals on tap class, I talk about how most people will tell you no. And that's okay. That's part of this. So you need to be prepared for that. But what you want to know is the ratio of how many no's on average do you need to get in order to get to that yes. So if you give up before you get a yes, you're never going to figure out what that ratio is, and you can't set goals around those statistics if you haven't gathered enough data. So go out, keep track of how many people you talk to, how many say no, how many say yes, and eventually you'll be able to look at that and say, okay, I need to talk to 50 people before I get a yes. I need to get 50 no's before I get a yes. And so that will help you set goals. That'll help you say, okay, I want to talk to 50 people a day so I can get a yes a day. Or I need to talk to 50 people a week so I get a yes a week. I'm not saying it's going to be 50. It varies for everybody. But, I'm just using that as an example number. And then set a goal for when you would like to have your first wholesale. So once you have that math in place that okay, I need a certain number of no's to get to a yes. I want to set a goal for when I want to have my first wholesale. So you're able to then make a mathematical goal to say, okay, I need to call 300 people by next week, right? Or whatever the case might be. But that's going to help you hit that goal. So when would you like to have your first wholesale? And then that's also going to help you understand how much effort is going to go into accomplishing that goal. So after your first, how many wholesales would you like to do per year, per quarter, per month, per week? So set goals for each of those things. How many would you like to do in a year? If this is a little more passive thing, maybe you're doing one a month or one a quarter. If it's a little more aggressive, maybe you're doing one a week, right? And that would mean that you're doing 4 or 5 a month, and that would mean that you're, doing 15 or 20 a quarter, and that would mean you're doing 52 a year. So set those goals and remind yourself of those goals on a regular basis. Put your goal sheet somewhere that you're going to see it every day. I like to put goals on my bathroom mirror because I know it's something that I'm going to see early in the morning, just as I'm getting up and starting to get ready. So it reminds me of what my goals are on a regular basis. Put it somewhere where you're going to be reminded of your goals. Also, something that I've found very useful in my life is creating a vision board. Why am I setting these goals? What am I trying to accomplish? Because sometimes the idea of making money, it just isn't enough, right? And we've all had experiences where we've given up on something. This is not something you want to give up on. There's the The reward is waiting for you. You just have to get all the way to the finish line in order to cash it in. So, create a vision board for yourself. I put things like cars that I want, and future properties that I want to have as secondary residences, and vacations I want to take, and all sorts of stuff. So, create that vision board and put it right next to your goal sheet, or even make it part of your goal sheet, so that it reminds you of why you're doing this. Whatever your why is, it could be your family, it could be paying off debt, it could be any of those things. But remind yourself on a daily basis what your goals are and why you want to accomplish those goals. Now, let's talk about some of the tools that you'll need. I have provided you with all of the spreadsheets and calculators that I use, and the tools that you're going to need in order to start going out and wholesaling are the same tools that I talk about in the off-market deals on tap class. The fix and flip quick analysis calculator is going to be something that you're going to need. A lot of your buyers are going to be fix and flippers. So you're going to go out and talk to sellers and get properties under contract, and then you're going to turn those contracts over to investors for a fee. That's how you make money in wholesaling. Well, a lot of those buyers of the contracts that you're going to be flipping are going to be fix and flippers. So you need to understand how they're going to be analyzing deals and putting in the correct numbers so that you can pass a good quality product along to the buyer. A lot of times I'll print out or I'll include a PDF version of my quick analysis calculator, just a screenshot of it, so that they can see the numbers that I ran and they can make any adjustments based on their own system. So the quick analysis calculator for fix and flip, as well as the quick analysis calculator for buy and hold. If a property like we've talked about, and we're going to talk about in future modules, there may be different uses for a property. You may go look at a property and run the numbers and it just doesn't work as a fix and flip, but it might work as a rental. And you may have buyers on your buyer list that want rentals. So make sure you have that buy and hold quick analysis calculator ready. And then also for seller finance type deals, you're going to need an amortization calculator to figure out what the payments are going to be on their mortgage and when you're going to pay that off. We use that in strategies where we go in and take over previous owners' mortgages, like the subject to strategy. I'm not going to take a whole lot of time to go into that strategy in this class because I cover it in great detail in the funding deals using other people's money course. So if you want more information on taking over other people's mortgages, taking over their payments, and getting their property in that respect, check out that class because there's a lot of information there. Now, let's talk about the team of resources that you're going to need. You're going to need to talk to some money partners. Now, these are not necessarily for you, but as I'm going to talk about in a few minutes, it creates a more valuable product if you've already got some potential money lined up for these investors. So you want to have at least a relationship with a debt lender, with an equity partner, with a potential credit partner. You're definitely going to need a title company. That's probably one of the most important relationships in any type of real estate investing. You're going to need a relationship with a title company. So I would go start talking to title companies and developing those relationships. For the buy and holds, you're going to want a property manager and a relationship there that you can recommend to your buyers on your wholesale list. All of these people are going to be beneficial because not only are they resources that you can pass on to your buyers and add value to what it is you're selling to your buyers, but it's also going to be something that these relationships will help you run your numbers so that you can provide accurate projections to your buyers. And that's important because if you're not providing accurate numbers when you're wholesaling, people will catch on to that after a few deals that they look at. And if your numbers are always off, they're not going to trust you anymore. You have to have accurate numbers when you're wholesaling because that's how you create that relationship with your buyers, and your buyers are how you're going to make money. It's also important to have a relationship with a contractor. There's in a fix and flip scenario, for example, it's very construction intensive. So you're going to want a relationship with a contractor that you can bounce pricing off of and talk to about the different things that are going to be needed in a property. Another example of a relationship you'll need is a home inspector. I always pass an inspection report along to my buyers so that they know what's wrong with the property. It also makes my product, the contract that I'm selling, it makes it more valuable. I can charge a higher wholesale fee because I'm providing more value with the numbers that I'm providing. A lot of times I'll provide equity partners or debt lenders as part of the deal. And having a home inspection just sweetens the deal. You can charge a higher rate when you have a more valuable product that you're selling to these investors. So, and that leads right into this. So remember that the more you offer with your wholesale deals, the more they're worth. If it's only a contract that you're selling, the deal might fetch a smaller wholesale fee, but it will also take less time. So you can be the wholesaler that just flips the contract and there's nothing else attached to the contract. You're probably going to make a smaller fee on that, but also it takes less time, so you can do more of them. So that's an option. But the more you offer with that contract, the more it's worth. I like charging between $10,000 and $15,000 for my wholesales as my wholesale fee. But I can do that because I provide a lot of value. I'm putting in the home inspection. I'm a lot of times, providing a contractor contact, and it's the contractor that came in and gave me a bid on the property. A lot of times I'm sharing money relationships, and that makes it worth more. If you're just flipping the contract, you're probably going to get a little less than that. You might get $4,000 or $5,000 for a wholesale, depending on the market you're in. No, there's no average results in real estate. I can't give you an average. It's just going to be what your particular market drives. But I can tell you that the more valuable the product that you're creating, the more money that you're going to be able to get for your wholesale fee. Now, let's talk about the math that's necessary as you go in and analyze this. And once again, I know I've said this a lot in this course, but the sister course to this is the off-market deals on tap class. I go into much more detail on the math that you're going to need to use. But let's talk about the math both for short-term, and then we'll get into the long-term strategies as well. But this is going to be the math that you'll use for like a fix and flip property that you're going to wholesale. So for a fix and flip, it's always important to start with your after repair value, or ARV. The subject property's ARV is determined in two ways, and that one of those ways is recent sold properties in the area. So we call those comparables. They must be properties that are similar in home style. So if it's a rambler that you're looking at, you got to compare it to other ramblers. If it's a 2-story, you got to compare it to other 2-stories. If it's townhome, other townhomes, etc. Right? The other way is an appraisal completed by a licensed appraiser after the work is done. Obviously, work's not done yet, so we got to use that first way. You got to use recent sold comparables. Now, emphasis on the word sold. Don't just look at properties that are listed on the market, right? It has to be properties that have actually sold, because then you'll know exactly what the sale price was, and that's how you're going to determine what your after repair value is. You want at least 3 of those comparables, and then you're going to average out the sell price, and that's going to be what you can sell your property for after the repair is completed. Another important point is your comparables should be remodeled properties. You shouldn't be, it'll dilute your price if you're looking at properties that haven't been remodeled yet. So if you're analyzing a deal as a potential fix and flip that you're going to wholesale to a fix and flipper, make sure that your comparables are remodeled, of the same style, built in a similar era. So if the subject property you're looking at was built in the 40s, try to stay within that decade. With your comparables, your comparables should have been built in the 40s as well, right? Similar square footage, within probably a mile or a half-mile radius, and sold within the last 90 days. So let's talk about how to find those comps. The best way is to use an agent or the MLS. An agent's good, and that's the relationship that you can use. An agent is going to have access to the MLS, and they'll be able to pull up data on what properties have sold recently, and they'll be able to get you a comparative market analysis based on those comparables that will give you a really good idea. Like I said, you just take the prices from however many comparables you have. You should have at least 3. If you're looking at 3 properties, just add all of the sale prices up and divide it by 3, and that's your average. That's what you're going to be able to sell your property for. Other resources that I find to be a little less reliable are things like Zillow, Redfin, some of those free sites online. So you can use those, but I think an agent or the MLS, leveraging relationships is what's important here. So don't forget the quick part of the quick analysis. This is not a deep discovery period. You shouldn't be spending hours and hours and hours per property, plugging the numbers into the calculator. It might take you a little longer than usual the first couple of times you do it, but after you get used to the process, this should be just something quick. Just takes 5-10 minutes to do. So this is just a quick way to see if the property is worth your time or not. So let's talk about comp criteria. I know I kind of glazed over this, but let's dive into a little more detail here. A comparable must be a sold listing. Don't get tempted by listed or under contract properties. It must be something that has sold, and preferably sold within the last 30 days. You can expand your search if you're having a harder time. So if you're, if 30 days you can't find 3 good comps, go back to 60 days and then go back to 90 days. I wouldn't go much past 6 months, I'd say at the very, very most. But try to keep your criteria tight and then only expand if you need to. So start with the smaller number and then work your way up to the bigger number. Never cross imaginary lines. Start with a half-mile radius and looking for comps. And I'm talking about a half mile from your subject property. But don't cross, if there's an interstate, a lot of times properties on one side of the interstate are worth a different amount than properties that are on the other side of the interstate. So, or major thoroughfares, if like State Street, for example, if you got a State Street in the area you live in and properties are worth more on one side of State Street than they are on the other side, make sure you don't cross that line to pull comps, because that's not going to be a good comparable for you. Also, they must have a similar build style, like we talked about. Number of beds, number of bathrooms, garage. Get it as close as you can to the subject property to get more accurate numbers when it comes to calculating your after repair value. If you can't find at least 3 comps that fit this criteria, it's not a deal. It's the reason we go and do the math and do this analysis is to keep us safe, right? And if it's not going to be a deal that you would do, don't go sell that deal to someone else and guess, because then you're just going to gain a bad reputation, and it's going to hurt you more in the long run than the short-term gain you'll get by selling a bad deal. So if there's not 3 comps, it's not a good deal. It's time to move on. A solid comparable analysis keeps you safe. Now, this is a snapshot of our calculator. It's our fix and flip quick analysis calculator. It gives you a spot to go in and put in those 3 comparables, and it will actually generate an after repair value for you. So it'll average those out for you. So all you have to do is go in and put in the light orange here on the right hand side of the screen. All you have to go in is put your comparable price, the sold price for each comparable, into those sections, and then in the blue section it will automatically calculate for you an after repair value. So it gives you a good place to do that. Don't forget to pay yourself. I know it's a small part of the calculator, but sometimes people forget to calculate their desired profit. You get to decide what that is. Now, my recommendation for this is don't go overboard. Don't put $100,000 in there, because then you're not going to find any properties. You're not going to get anybody to agree to your offer. Start with your minimum desired profit. For me, that number's $30,000. Doesn't necessarily need to be that for you. You can pick any number you want. But what's the minimum that you're going to be looking for in your desired profit? Now, keep in mind, we're talking in the context of wholesaling right now. That is not your wholesale fee. That's the profit as a fix and flip. So this is going to be for your buyers. Whoever buys this property, this is the amount of profit that they're going to get. So as you create a buyer's list and go through, and I just keep mine on a Google spreadsheet. You're going to want to keep track of their name, their phone number, their email address, what type of investor they are. Are they looking for fix and flips or rental properties? Keep notes on what their desired profit margin is. Like if their number is 30,000, or if their number is 40,000 that they need to make on a fix and flip in order for them to want to do it, put that number into that into that calculator so that they can make their 40 grand. Because that makes it something that's going to be desirable for them to buy as a wholesale deal and go and do the fix and flip on. So you need to be mindful of your buyer's list as you're working that part of the calculator. Now, it also gives you a spot for buying costs. This is where, having a relationship with a title company, they're going to be able to tell you what their fees are. Attorney's fees, pest reports, surveys, inspections, all of those things. When you first start doing this, you're going to have to create those relationships because it's different for different parts of the country. So you're going to go out and have to start building some relationships with title companies and inspectors and attorneys and different things. But once you've done 2 or 3 of these, you're going to know what those prices are, and you can just start filling those in from memory. Or I like to just put it into the spreadsheet and save the spreadsheet so that it just has it auto-populated in there for next time I come in. So a lot of good ways to do there. You're going to be filling out the light orange boxes, and then the blue box will calculate for you the sum of all those costs. You're also going to do the same with selling costs, your closing agent, your advertising, your internet expenses, your signs, your recording fees. Sometimes some of these lines are going to be 0, and that's okay. You don't have to fill every line with a dollar amount. It can be 0 if it's 0 on that particular deal. So that will calculate all your selling costs. We're going to do the same for holding costs. What are your mortgage payments? If you're using hard money, then that's going to be your interest, your insurance, your cleaning, your maintenance for lawn and snow, your utilities. This is stuff, again, you're going to have to do. It's going to be a little bit more work as you start this out to get all of those numbers together. But then as you move forward on your 3rd, 4th, 5th, 10th deal, you should just have those numbers handy and be able to just plug them in. And that's where really this becomes a very quick process. So then you're going to want to put in your estimated repair costs. I would get an opinion from a contractor on this. And I would include, when you sell the contract, include the bid that he gave you. Because if you're sending him business, he's going to be willing to keep estimating deals for you, right? So a relationship is about creating value on both sides. Make sure that you're recommending, if you've got a contractor that's willing to come in and give you bids on your wholesale deals, make sure you're recommending him to your buyers, to your customers, when you flip that contract to him and say, look, this is what this guy said he would do it for. This deal works great if you just use him, right? So you're going to want to put your estimated repair costs in there. Now, the whole goal of doing the quick analysis is to calculate what your offer price is going to be. And that's very true here. So the equation is simple. It's going to be your after repair value minus your profit, minus your buying costs, minus your selling costs, minus your holding costs, minus your repair costs. And that should be automatically generated for you if you use the tools that are included in your education and this quick analysis calculator. That should just auto-populate for you as you put all those costs in. Now let's talk about long-term buy and hold. You should be looking at each and every property through multiple lenses. What are the numbers on this property if it's a fix and flip? What are the numbers on this property if it's a buy and hold? You can plug those same numbers into your buy and hold sheet. So let's talk about a few of the important things there. Gross rent is the amount of money that your tenant pays. So if you charge your tenant $1,000 a month, then your gross rent is $1,000 a month. The only way to calculate a market comparative gross rent is rent comps. So you need to figure out what other properties in that same neighborhood are renting for and be able to be comparable to that so that you're competitive in that particular market. So there's a few ways to get accurate rent comps. One of my favorites is just a relationship with a property manager. I just text or call my property manager and they get me back numbers on what a potential property could rent for. A few other ways, there's some tools on the internet. Rentameter.com I've used several times. Ziply.com, Zillow.com. There's a lot of different places out there that keep track of that kind of data that make it really easy just to go out and get rent comps or a projected rent price. Now, keep in mind those internet tools I found to be a little less reliable. Not to say that they're always wrong, because a lot of times they're right, but I found them to be slightly less reliable than just having a good relationship with a property manager who can help me run those comps. Always account for 8 to 10% vacancy. So your effective gross income on a property is going to be your gross rent minus your vacancy rate of 8 to 10%. That's going to be your effective gross income. So now that we know that, let's take that effective gross income and let's work some numbers based on that. NOI stands for net operating income, and the equation is simple. We're We're going to take our effective gross income that we learned how to calculate on the last slide, and we're going to subtract any expenses from that. Now, NOI does not include debt service as an expense. That's calculated separately. So when we're talking about net operating income, it's all of the expenses with the exception of the debt service or the mortgage payment, right? Is what I'm referring to when I'm talking about debt service. So it's your effective gross income minus your utilities and your insurance and your taxes and your garbage fees and your sewer fees and all those, your property management fees, all the fees with the exception of your mortgage payment, and that's your NOI. So now let's talk about debt service. Debt service simply refers to the cost of your property debt. The easiest way to think of it is just as your mortgage payment. So all of these equations that we're running are getting us down to the important thing, and that is we want to calculate cash flow. So now that we've learned how to calculate effective gross rent and NOI, here's the equation for cash flow. Your cash flow is equal to your NOI minus your debt service. Now, the reason we calculate NOI and cash flow different is because as a wholesaler, some of your buyers might have cash that they just want to come in and buy, and then there's no debt service, right? So NOI is going to be the number they're looking at. A lot of investors, however, do need to borrow the money. So they're going to be getting that from different sources at different terms. So they might want to know what the NOI is and then plug their own debt service in to get their cash flow. But I find it's important just to give an analysis that includes all of those things: effective gross rent, NOI, and cash flow based on your projections. Remember that cash flow is king. Smart investors use all of their investing strategies directly or indirectly to support their acquisition of cash flow. So here's a little snapshot of the calculator. This is the buy and hold calculator, quick analysis calculator. It accounts for down payment, carrying costs, for pre-occupancy. So that what that refers to is how many mortgage payments you project you're going to have to make before you get tenants that will offset that mortgage payment with their rent. Buyer closing costs, initial repairs. That's going to vary on every property. It's just a property-to-property thing, but the calculator gives you a spot to estimate that. Sometimes the number's 0, and that's okay, but it gives you a spot to fill that in on a property-by-property basis. You fill in the light orange. The blue will automatically calculate those things for you. It'll also calculate your ROI. So that wraps up the preparing for a deal portion. That's everything you need to know about goal setting, about running the math on deals, about the tools that you're going to need, the relationships you're going to have, and that concludes our module 3 for this wholesaling module. Next, we're going to be talking about finding properties and the strategies that you'll need to be using there. So I look forward to seeing you guys in the next module. I'll see you over there.